What's going on out there? It's Tuesday, September 13th. And I'm Frank Curzio. It's the Wall Street Unplugged podcast where I break the headlines and tell you what's really moving these markets. That last part means a lot today, doesn't it? What's really moving the markets. So I'm going to have lots of listeners just for today's podcast. With the market down sharply. We're looking at the Dow down 2.5%, NASDAQ down over 4%. Most of the large technology companies down over 7% today as the CPI, consumer price index, came in much hotter than expected. The CPI is the gauge the Fed looks at as its inflationary indicator. So the past 40 years, inflation surged well into the double digits in the 80s, and before that. The Fed revised this index numerous times to where the CPI, it masks inflation. It hides it. And this is factual. You can go look at it. But hear me out. This is very, very important for you to understand. Nobody really talks about this. So these revisions took place between 1983. Remember when we had massive inflation, 70s and 79 into 80, right? Well into double digits. So these revisions took place between 1983 and the mid-1990s, where they introduced the rental equivalence concept, and that was in 1983. Then they revised this more than 10 times through 2013. Now, most of these revisions took place from 1983, conveniently after we saw the biggest inflation period in our country's history outside of World War II, through the mid-1990s. So I want you to Google it. I won't bore you with the details. I love this stuff. I love reading it. It's difficult to read, but when you look under the hood, which I'm going to give you the details now, it's fascinating. It really is. But you can Google it. Google owner's equivalent rent and the consumer price index. Click that link and read it. It's incredible. It's a little bit boring, but I'm going to simplify it to you because it's relevant to today, more relevant than it's ever been in at least 50 years. So when looking at inflation between 2010 and 2020, it averaged 1.5%. 2010 to 2020, right? So you're looking at just before COVID started and between, right after the credit crisis. So it was under 2%, which significantly, that's the benchmark, right? They say as long as it's under 2%, we're going to be fine and we don't have to raise rates. That's the benchmark, that's the benchmark, that's the benchmark. They always change the benchmark going forward. I want to talk about that. But if you're looking from 2010 to 2020, beginning of 2020, you're looking at inflation was averaging under 1.5%, and that's based on the CPI. But you and I, who buy shit, are like, wait a minute, that cannot be right. I mean, look what I'm paying for my kids to go to school in tuition. Look at electricity, look at food, look at healthcare, look at transportation. Almost every bill that you pay was up well over 2% year over year from that time period. But it was not represented or had a big weighting in the CPI. So basically, every consumer knew that the CPI was bullshit. We all knew it. But the Fed uses that gauge as that indicator. And this is intentional. Even the revisions were intentional. It allows the Fed to keep rates low. Now, what does that do? It's great for our economy, promotes growth. We'll also keep inflation in check. I'll tell you why in a minute. While also allowing the government to aggressively spend money supporting the agenda of whatever party's in power, which is pretty important to the Fed chair and even the vice chair, since the president is their boss. He's the one that nominates these positions. So they have a very huge incentive to try to keep rates as low as they can and mask that inflation. But due to these revisions over the past 30 years, this is why shelter now accounts for 30% of the CPI. Again, there's no coincidence here. So if you add in food and energy, the next biggest component, you're looking at 54%. Those three things, shelter, food, and energy, account for 54% of the CPI. Stay with me here. It's going to be extremely relevant to how you position your portfolio over the next few months. So also conveniently, the Fed, what do? Is they're like, this is what we're going to do with this. And we're going to strip out food and energy because it's volatile. It was higher than lower, and it's not a true gauge. So if you strip out food and energy and you look at the rest of the CPI, nearly half of that is shelter. That's the reason why inflation stayed low for such a long period. Why? Because historically, we don't see rentals rise by an exceptional amount year over year. We just don't see it. Or even home prices rise by an exceptional amount on an annual basis. And this is pre-2006, 2005. which basically caused a credit crisis because housing never crashes. It never crashes. Even though it's going to go up 20% annually for 5 years into 2007, it never crashes. So what did Wall Street do? Trillions were leveraged to the housing market. Again, they said it's never going to crash by more than 5% and we'll be fine. It wasn't subprime. It was the leveraging, the massive trillions and leveraging to that, right? Let's create all these packages and then sell them to Wall Street. Pay off the rating agencies and put AAA ratings on this. No one's going to look at 300 to thousands of mortgages in this package. No one's going to look at that. And the chance of them all crash at the same time is minimal. It's not going to happen. We know how that turned out. Nobody got arrested in the banking sector, right? We saw the market crash. The world almost ended. But it didn't because you and I, taxpayers, needed bailout financial companies, which, by the way, are 5 times larger than they were pre-2008. What a great scenario. Again, linked to housing. But let's go back a little further for the CPI. And again, stay with me here, because this is pretty fascinating. So we go back to the mid-1990s. That's a pretty long time ago, right? So over 25 years. You know how many times we saw the CPI break the 4% barrier annually? Take a guess at that. How many times since, you can go back to 93, 94, 95, where the CPI broke 4%? 0. It never did. In all those years, don't look at tuition, don't look at transportation, don't look at any other cost, right? Because you're going to see it went up wildly, I mean, much, 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 much more than the CPI. But the CPI itself, it never was above 4%, ever, until recently. In fact, it only broke the 3.5% barrier once, and that was in 2008. It only went to 3.8%. So the Fed made its biggest inflation indicator, the CPI, of what they look at, what they tell everyone to look at, basically inflation proof. Of course, that was until someone had the bright idea to inject $11 trillion, fiscal monetary money, that amounts to over 50% of our GDP, into the U.S. economy in 18 months. And by the way, the 11 trillion, a little over 11 trillion, that's just in the U.S. If you look globally, it's 23 trillion was injected in 2020. You can say, all right, we closed it. We didn't know, the scope of COVID. Fine. Okay, I'll give you that. But what about in 2021? I mean, 2020 in November, that's when the vaccines came out. We saw all asset prices. I mean, we're looking at March, April when the market came down, and then all of a sudden it surged, and it just kept surging and surging into the end of the year. Then into 2021, where almost every asset class was at a record high because you just injected so much money into the system. It's never seen anything like. Everyone had money. Everyone. They were handing out checks no matter what you did. Here, PPP loan. Oh, go ahead. Look at all the people who had PPP loans. Kardashians took them out. Harvard applied for it. Like all these, you didn't need it, but everyone's like, hey, if the government's going to hand this money, we're going to take it. We're definitely going to take it. That's what politics is all about. Have the government pay for whatever it is. Al Gore, climate change, and you're rich forever. So now we're into 2021, and another $9 trillion was injected into the markets. Another $9 trillion. Why? Why do we go $9 trillion? Why do we need that? I mean, jobs were back. We're seeing everything come back. And the funny thing is, if we go into 2022, another $3 trillion. $3 trillion was injected to the system. What the fuck for? Why are we injecting $3 trillion in 2022? Why? I mean, look at it globally. Maybe you could see it in some areas, but why? Why are we still going crazy here? Anyway, you're looking at these numbers, they're absolutely insane. You have to put them in perspective. Again, TARP to save the world was $480 billion, $3 trillion in 2022. What for? But who cares? Nobody's looking and nobody cares. It's trillions. And what's the difference between 3 and 4 trillion? Are you really going to say, holy shit, I can't believe you went from 3 trillion to 4 trillion and the government's going to spend this or the Fed's going to, would you really? No, it's the same thing. 3 trillion, 4 trillion, 5 trillion, it's the same number. It's the same number. That's how we've been conditioned. That literally is the same number. Nobody's going to say, oh my God, I can't believe they went from 3 trillion to 4 trillion. No, nobody knew that globally. Central banks injected another 3 trillion in 2022. I guarantee you nobody knows that fact. I didn't know it until I looked it up. I was looking at the numbers for 2020 and 2021. Thank you, Bank of America, for having this. These numbers are insane. Anyway, let's bring it in here, and let's fast forward to today. Inflation is crazy high. More than 8% year over year, highest since the 80s, and the Fed has absolutely no clue. Absolutely no clue. They never thought inflation would go this high. That's why they were saying, the transitory speak for the Fed over the past 2 years. I mean, that and coupled with the way the CPI is constructed. They're like, it's transitory, it's transitory, it's transitory. Don't worry about it. I mean, we never see rentals, even during the major move in housing prices, we didn't see rentals skyrocket like they did over the past 2 years. We didn't see that. It's usually a gauge. Hey, let's make this the biggest part of the CPI, 30%, because usually on average, if you look, it goes up conveniently around 2%. That's the median. If you're dating back to like 2003 when they made up so many of these changes. So that's fixed. And then we have food and energy, which is going to be, 54% of the whole index, including shelter. But you know what? We'll strip out food and energy. This way, the CPI will always remain low. It won't be high. But again, now look what's going on. You inject all this money into it, and you're like, wow, looking back at history, right? And these guys, the Fed, they're book smart. They're not street smart. They look at past data showing that rising inflation is almost always transitory. Almost always transitory. But you got to factor in the amount of money that was just injected into these economies, which we all knew. Everyone knew we're seeing wild inflation. Everyone who pays a bill, from a 16 or 17-year-old that pays their phone bill or whatever bills that they pay, maybe even more, to 60, 70-year-olds or whatever. We all saw it. We all paid the bills. We're seeing, look at inflation. And the Fed's just looking at us with this dumb look. It's transitory. You got nothing to worry about. It's transitory. It's transitory. It's going to come down. And they were wrong, and very wrong. And now that leaves them in no man's land. They're just sitting there going, what the hell do we do? Because the traditional indicators they used to study the markets for decades and decades, they no longer apply. They no longer apply. That's why the Fed, what are they doing now? Holy shit, they don't know what they're doing. They're aggressively raising rates. And they're not just raising rates. And in January, you have to look at the economists. These are supposed to be the smartest people when it comes to the economy. They're not. If they were really, really smart, they wouldn't be economists that have bigger jobs. But they're economists, and people look at them and say, okay, these are the people we're going to listen to. And then we take the average of them. The average of them predicted there would be 4 rate hikes this year. 4 rate hikes at 25 basis points. They didn't even call them 25 basis point hikes. They said we're going to have 4 rate hikes this year. You know why? Because 99% of the time when you raise rates, you do it by 25 basis points. So they didn't even have to justify it. In January, they were saying this. Even in February, they were saying this. Look at Goldman Sachs. They went from like, maybe 2 to 3, and then they said, okay, we're going to get 4 total now. And they didn't say we're going to get 4 total, like a 50 basis and then 2 25s. You know, that would be 3 or every 25 basis point hike is 1. They just didn't define it because every hike was considered 25 basis points. Now look what the Fed is doing. And they're raising by 50 basis points, then 2 75 basis point hikes immediately, right? Month to month. And now they're going to do at least another 75 basis point hike based on this number. The CPI that came out ran a little hot. Based on this number, the Fed futures are predicting that in 2 weeks, less than 2 weeks, week and a half, they're going to come out and they're going to do a 75 basis point hike. And there's an 80% chance that they do that. The 20% isn't for 50 basis. It's 20%. There's 0% chance that they're only going to raise by 50 basis. The other 20% is that they're going to raise by a full percentage point. Like, there's 0 consequences for making this massive decision between how much to raise rates. I mean, you're looking at it, there's no playbook. There's no playbook out there for how fast, how aggressively the Fed is raising rates to where we were at 0 in January? And where we're going to be 4% in December? I mean, I know maybe the people who aren't familiar with the markets, that might not sound like a big deal. We've almost never seen that in history of how fast the consequences that are going to take place from that are massive. They're not even close to being factored into the markets right now. Even the last 75 basis point hike is not factored into the markets. So the latest CPI number, which came out earlier today, is not good if you're long stocks. And this is what scared me, because the Fed's tone. The Fed has the ability to create a really nice, healthy market next year. But they're not going to do that. They're going to make a huge mistake. And it's going to be even bigger than the mistake they made a year ago, 18 months ago, 24 months ago, when they said that, hey, this inflation, 5% it was last year. Last year's Jackson Hole was 5%. The Fed went out there, spoke Jackson Hole and said, look, hey, it's transitory, guys. Don't worry about it. When we hit 5%, and that's the first time we hit 5%. Again, we haven't seen CPI at 4% since the 80s, since we made all these adjustments. And that's why he's like, it's transitory. It's transitory. It's shelter. We got nothing to worry about. We'll strip out food and energy. We'll be fine. It's not going to go much higher. The cure for higher rates is higher rates, and people will stop paying higher prices. Inflation's going to go down by itself. It's going to be transitory. Wrong. They're going to make a bigger mistake this time than they did back then. And look how big that mistake was. Look what it did to the market. So if they aggressively raise rates, which the futures are suggesting, again, calling for 75 basis point increase in a little over a week when they meet, 20% chance they're going to raise by a full percentage point, and then come out with the same tone they came out with Jackson Hole and saying, we're going to continue to raise rates aggressively for the rest of the year, where we still see no indications of inflation slowing. If they come out with that tone, look out. Look out. Because my advice to the Fed, my advice, and who the hell am I to give anyone advice, but my advice to the Fed, I think we've been pretty steady on this so far for the past 2-3 years when it comes to getting in and out of the market based on the stupidity of the Fed and what they're going to do and doing the opposite of what they're saying. My advice, ignore this CPI report. I know it's hard to do, right? We all think short term, oh my God, inflation, no, it's going back higher, it's going back higher. It's an anomaly. Rentals are going down. This is based on data reported by Diana Olick. They're gone down. They're not going up as much. They were going up 4 times faster, and they've cut back. It takes a while for that to filter through the system when it comes to rentals. It takes a while, just like it takes a while for, as they thought, for rentals, it's usually a steady amount, and it doesn't go up by a lot or go down by a lot. If it does go up a lot, it's not crazy, right? That's why they constructed the CPI and put 30%, made 30% shelter. Now it's coming to bite them in the ass because that's the biggest component. And yes, we saw food go higher, but energy came down. But if you're looking at rentals, okay, you can go to rentals, right? So let's look at the reasons why inflation's high. Rentals, which is coming down based on data today. This is a lagging indicator today. They're coming down, and they're going to come down even more sharply. The housing market it is done. It's done. If you look at the housing market, holy cow. You wanted like a screeching halt to a massive growth market? You just did it. You just did it. You're looking at the velocity of money, which I talk about in past podcasts. It's already crashing. That indicates money's coming out of the system. It indicates recessionary times. We're already at levels right now not seen since the Great Depression, and you want to continue to raise rates. You're looking at housing. I mean, just to put in perspective, mortgage rates are 3% in January. They're 6% today. What does that mean? The average home right now at $500,000, you put 20% down, you're taking, a $400,000 mortgage out. Just on a $400,000 mortgage. The difference between 3% and 6% is a monthly payment that's $700. Monthly, not yearly, monthly. $8,400 a year right out of your pocket. You know how much money that is for most people? Simply because you didn't buy a house 9 months ago? The same house that you were looking at that you're like, oh, okay, well, let me just wait a little bit and see. And now, nothing. What's changed? 9 months ago. You know how much money? They put that in a calculator and go over 30 years and look at that amount. I mean, times at 8,400 times 30 years, you're looking at hundreds of thousands of dollars in extra payments simply in a 9-month period because the Fed went nuts on rates at 6%. So 8,400, and that's, for regular middle-class home. What about lower income levels? I mean, think about it. Now look at energy prices. Energy prices are coming down, which, by the way, people like, well, energy prices are going to go up. They're, the strategic oil reserve, they're taking so much out of it. And true. And energy you could see go high. But I'm going to tell you, energy is a good place. I think the stocks are going to do well. But I think energy prices stay around here. I mean, I think you're going to see them between 70 and 90, pretty much. Maybe they go higher. I still think oil is oil is a good sector to invest in. Oil has come down, and you notice how the stocks continue to go higher. I mean, you're going to see those profits. You're going to see earnings potential. It's one place that you'll see growth year over year, where you're not really seeing growth in earnings. If you look at earnings, they're down 4% year over year. If you strip out energy, that's big. Companies generate less earnings. That's the S&P 500 as a whole. Those earnings are down 4% year over year. If your earnings are down, what do you think that means with the job market? I mean, so these higher rates are resulting in consumers cutting back on spending. That results in less pricing power for companies, and that translates into what I just said, lower earnings, which are being lowered Not only were earnings only down 4% year over year if you strip out energy, which is every other sector, 10 of the 11 sectors, but they're being lowered significantly into next quarter at one of the fastest rates in years, which is why, according to PricewaterhouseCoopers, PwC, they just came out with a recent survey. And it was, I looked at the details because sometimes surveys are like, well, we surveyed 5 people. And based on these results, the market's going to go down 97%, right? I mean, this is what they do, consulting. All right, so PwC, this is 700 companies, executives, like spread out, real survey. 50% of companies said they expect to lay off employees over the next couple of quarters. Look at Goldman today. Goldman laying off employees. What's that? Rent the Runway stock or whatever that is, cutting 25% of its staff. PVH, which is a power company, cutting Netflix, laying off 20% of its staff. Snap, 20% of its staff. Alibaba, 1/3 of its staff. Remax, 17% of its staff. Peloton, Robinhood, Spotify, Rivian, GameStop, Tesla. What about JP Morgan and 7-Eleven? Those are businesses that should be thriving. I mean, higher rates are good for banks. JP Morgan's laying off. 7-Eleven, 40% of their sales comes from gasoline. They're laying off. Everyone's laying off. And it's going to be almost every company because profits are going down. Which means what? What has the Fed been saying? We're not in a recession. We're going to redefine recession. It's not 2 quarters of negative GDP. No. Why? Because the labor market's strong. The labor market's strong and higher wages. So those 2 catalysts the Fed is citing as reasons they need to raise rates, or the reason why, hey, you know what? Our economy is still pretty strong. They're guaranteed 100% to get significantly weaker going forward. Guaranteed. But if you're looking at all those details, rentals coming down, companies losing pricing power, the housing market shut off, you throw in China and Europe already in a big recession, where's the growth coming from? The Fed significantly raising rates. How do you expect the job market to stay strong? Look, stop looking at data from the past and just do a little homework and use your freaking common sense. Listen to the companies. Listen to what they're saying. They're reporting. Listen to the conference calls. They're telling you exactly what's going on. Listen to their tone from this quarter compared to last quarter compared to the quarter before. 2 quarters ago, they're like, hey, we're still seeing... Last quarter, like, half of the companies are like, well, we're still weathering okay, but we're cautious. Now, look what they're saying. Different tone. Well, we're laying off employees. What does that tell you if they're laying off employees? It tells you business is not strong. They're seeing weaker demand across the board. It's the reason why technology companies are getting smoked today. You get more impacted from higher rates because they make all their money from spending, and consumers and businesses are going to spend a lot less if they're making less profits. Does it make sense? Did I lose you? Hopefully not. But just based on that, you're looking at this report. It's enough reason to ignore this data that came out for the CPI, which is going to make these guys go absolutely nuts in September, in a week and a half from now when they meet. They're going to go nuts. Oh my God, what do we do? We got to raise. Holy cow, we got to raise because we said it was transitory. We don't want to look like idiots on both sides. You're going to look like idiots on both sides. You're going to make a bigger mistake. But if that's not enough reason to ignore the report, just look at the inverted yield curve between the 2-year and 10-year. It's widening. It's widening as both of these yields are approaching their highest levels since the credit crisis. But the widening of that yield curve, it was negative, right? It's negative yield curve. Not only is this an extremely reliable recessionary indicator, right? When we see that, it tells us right now that what the Fed is doing, raising rates aggressively, it's not working. That's why it's widening. And that's what we have when the 2-year yield is much higher than the 10-year yield, right? Inverted yield curve. And it's widening. It widened today because it's telling you that the Fed, it thinks the Fed's going to raise rates, and it shouldn't. Stop raising rates. That's the indicator right there. So one more cut, fine. 75 basis point, fine. But focus on reducing your balance sheet, less on raising rates, because it's clearly not working. It is working, but it's not working as fast as you think because you're looking at past data. But just look at what happened. Look at the velocity of money. Look at the money coming out of the system. Let's look at the restaurants. Listen to Walmart. Listen to Target. Look at the inventory levels. And these guys are like hoping and praying that we're going to see a bounce back and inflation is going to come down. They could sell us inventory at higher prices Just wait. If you're a consumer, just wait to Black Friday. You're going to buy a 70-inch TV and they're going to give you one for free. That's how much inventory these guys have in the balance sheets. And that came from everyone. Kohl's, Best Buy, across the board, retailers. It's why they're cutting staff. You don't cut employees when business is good and strong. And you're seeing every single day that comes out, more and more companies are laying off employees. And the more employees there are in the market, that's when you're going to see that wage. Right now, you could command, not even now, but for the past 2 years post-COVID, it's hard to get employees. Why? Because the best people could sit home and they're still getting paid by the government. They don't care, whatever. But now there's going to be a lot of smart people on the market. So your existing employees who want those raises, good luck. No, there's really good people out in the market right now. Sorry, that's when you're going to see wages come down. That's what happens. But you're looking at a Fed where one more cut's okay, but right now with the tone, if they come out the same tone, they go 75 basis points, even a full point higher, and they raise rates, and they're coming out and say, we're going to 4%, 4.5%, man, look out. Look out. Because raising rates is not just going to really hurt the U.S. economy, and we'll be okay, right? We'll see stocks come down, home prices come down, but it's going to destroy, absolutely destroy the global markets, which are saddled with debt. All because why? Because you're getting information and data that is not reliable. It's not reliable. You can't tell me shelter should be 30% of the CPI, and the reason why you did that, there's a reason why inflation, again, it gave you the data that stayed below 3% almost every single year, barely broke through 3% almost every single year since the mid-90s. Why? Because, hey, and look at it. Read what I told you and look it up. You're going to see why, how they kept revising it and revising it and revising it. Where they won't include the costs of homeowners who are renting that actually pay the electric. And I mean, it's fascinating the way they twist it around. These are all algorithms that they're using. These are all algorithms that work. And algorithms work until they don't. And then you get the housing crisis. The CPI doesn't work. It's not telling you, it's not giving you a good depiction of what's going on with the economy right now. And if you just sat on your hands, one more rate hike and sat on your hands, you'll see it. You're going to see it. It's all out there for you to see. Just look under the hood a little bit. But if you're going to aggressively do this, look out. You're going to see food and rent, see prices fall likely sharply in these areas in the months ahead. As the labor market, wage growth shits the bed. Housing, the biggest driver of growth of the past few years, is basically a non-factor. And the Fed removed this growth component by raising rates so quickly, but immediately removed that component. I mean, how much stuff is bought when you get a new house? And that fuels the economy. Turned off. 2 seconds. But right now, after this number, you need to be careful here. That's why the market is selling off sharply. We're already in a global recession right now. We're in a global recession. The definition of a recession, we are in a recession in the U.S. They could change it and say whatever they want, say the labor market's strong. Well, when the labor market's not strong, you're going to go back and say, hey, we were in a recession in 2022 when wages come down tremendously, the job market's shitty in the first, second quarter of next year. Are you going to come back and say, wait, we were in a recession? But we're looking at being in a global recession right now. You look at Europe, you look at China. And the Fed is about to aggressively raise rates further, removing almost every growth component, again, housing, China, Europe, tech from the market. So without growth, what does that mean? If you're looking at S&P 500 and multiples, where were we? The average over the past 5 years, we're trading at 16, 17 times. We traded above 20 times, deservingly so, because the economy is growing. Companies were putting up amazing numbers. You see Google, Microsoft, Apple. You see the numbers they were putting up like a year and a half, 2 years ago? And it was like 3 quarters ago. Now it's different. The numbers are coming down. They're not as strong. You're not seeing a lot of growth. Again, growth year over year for the S&P 500 moving energy is down 4%. Now the Fed's going to go nuts on rates. So where should that multiple be? Should it be with growth slowing significantly? Should it be at 16, 17 times the average? It's not going to be at 20, 22 times because we're definitely not growing that fast, but we're not even growing enough to where we should be trading at 16, 17 times. So should it be 13, 14 times? If that's the case, based on growth and based on what the Fed is doing, we have another 20% downside here, which is scary. And this is all controlled by the Fed. The Fed has the ability to raise and come out and say, hey, we're going to wait and see and look at the data in October and November, which is going to be significantly different from what you just saw. Significantly different. And this is higher than even what I thought. I didn't think it'd be that high. I thought we see a minor decline, a little bit more of a decline. That's why you're seeing this huge reaction in the stock market. When everyone's on one side of the trade and we went up a few days in a row and everything's all great, great, great. This is the thing that I was worried about, is the Fed. I was very bullish about a week or two before we finally bottomed months ago, saying, listen, we're seeing inflationary indicators. A lot of them are coming down, which is good. And we still are. They're going to continue to come down. They went up a little bit higher than expected. Okay, fine. But this is one report. If they're really going to look at this report and determine what they're going to do for the rest of the year, look out. Look out. That's what's scary. It's very scary. And you need to be careful. You need to be careful. I'd say buckle up, have some cash on the sidelines, because by mid-2023, they're going to be aggressively, super aggressively lowering rates, because that's how terrible the market's going to be. Probably by March. If they're going to raise above 4%, they're going to come off that 4% number so quickly, because you're halting all growth in the entire market. And at that level, with the amount of debt all these countries have right now, look out. But that, if they do start lowering rates, is going to ignite a huge bull market, because prices are going to be a lot lower. So have cash on the sidelines. Not saying that this is definitely going to happen, but the Fed is in control. You don't want to fight the Fed. And if the Fed is going to aggressively raise rates, don't fight it. Regardless of all the data I gave you of why they shouldn't, don't fight it. If they do it, be smart. Say, okay, I'm taking some off. Take 30% off. Again, I could be 100% wrong. Don't know what I'm talking about. But now you're going to be able to buy lots of assets for pennies on the dollar. Very, very cheap. And you thought Microsoft was cheap here. You thought NVIDIA was cheap here, which at 40 times earnings, NVIDIA's not cheap. At 40-something times earnings, Disney's not cheap here. I don't know how companies like that have those growth multiples in this type of market. Where are you going to see growth? You better hope consumers spend. Yet, how are they going to spend if you're in a recession? I don't know. Especially when you're seeing the people get laid off, which they're getting laid off like crazy right now. Consumer spending is going to grind to a halt. You think they're going to go on vacation and spend a ton of money like they've done in the past couple of years? No. But just be careful and be smart. There's ways to play this. Listen to what we have to say in our newsletters going forward. It's not I'm telling you to sell everything, holy cow, but we could see a pretty steep decline where you got to position yourself rightly. Energy should still do well. Yes, during every recession over the past 5 years, we've seen oil come down. Usually it comes down during recessions, especially global recessions. It goes up just like it went up, and now it's come down. I still think it's going to remain relatively high. And it's, people don't think it's high now because it was 130, but at 85, 80, that's incredibly high if you're looking at the past 4 years. And if you're staying above 75, 70, 65, these guys could print money like crazy, and you're still going to see growth. Energy is a good place to be. Be careful of the aggressive sectors. The speculative stuff is probably going to get nailed. Look for dividend-paying securities, companies that are generating cash flow, and wait it out. Have cash on the sidelines, because you're going to be able to buy a lot of stuff at a discount. Don't get fully out of the market. Again, I'm not a genius. Sometimes I'm wrong. I could be wrong on this. Maybe the Fed comes out and says 75 basis point hike, and you know what? We are seeing inflation ease a little bit, so we're going to see the next couple of months of what we're going to do. That would help the markets, because that's why the markets went up the past few days. We thought we were going to see a decent number that shows inflation moderating, and the Fed won't go crazy and raise rates and have the same tone as Jackson Hole. That's why we went up the past few days heading into this report. That's why everyone's leaning on the wrong side, and this just punched you in the face. Let's see what the Fed does. Pay close attention. You could rail at the Fed. You could hate the Fed. You could say whatever you want. The only thing that matters is your money. Play it right. If you play it right, you're going to make money. I say it all the time. You can go out and hold up a sign and protest all you want, which I don't know how many people do, and I don't know. Those people should be getting jobs right now. It's not going to be easy to get jobs in a couple months from now. Or you could do something about it and position your money the right way. You don't believe in climate change, whatever. There's tons of money going to climate change. Buy the right stocks. So take the politics, take the feelings out of it, and just be smart. The Fed's going to be aggressive. Have some money in the sideline. They could inject into this market, because you're going to get a lot of these stocks and great names a lot cheaper if the Fed continues to raise rates, which I'm pretty sure they're going to do throughout the rest of the year. Let's see. I'll be back tomorrow with Daniel. We'll break this down again, see how much the market goes up or down, how it rebounds tomorrow. It's going to be interesting, but definitely join us tomorrow again. That's a podcast. Lots of listens with Daniel on it. Should be a lot of fun. We're going to cover a lot of this, and I'll see you then. Any questions, comments? feel free to email me, frank@curzioresearch.com. That's frank@curzioresearch.com. I'll see you tomorrow.